Your pension fund just sent you a notice. It says you received a distribution from a private equity investment. That sounds like good news. It sounds like a company sold, a profit was made, and you're getting your share. Except in a growing number of cases, none of that happened. What actually happened is the fund borrowed money against assets it still owns, and mailed you a check with that borrowed money, calling it a return. This isn't one company doing something shady. This isn't a Ponzi scheme or a single bad actor cutting corners. It's a structural feature now built into a multi-trillion-dollar industry, and almost nobody outside of finance has ever heard the term for it. It's called NAV lending. Here's why it exists. Private equity used to run on a simple loop. Buy companies, grow them, sell them, send profits back, but exits have basically stalled. Funds are now sitting on roughly $3.8 trillion of unsold companies, and the actual cash going back to investors has dropped to around 11% compared to almost 30% historically. So funds found a workaround. A NAV loan means borrowing against the entire value of the portfolio, not a single company. Think of it like a home equity loan. You haven't sold the house, but the bank lends you money against what it's worth on paper. Meet Karen, a pension portfolio manager. She committed money to a fund years ago and barely saw any cash come back. Then one quarter she gets a distribution, $8 million. She's thrilled. Her returns just jumped. Nobody asks where the money actually came from. But behind the scenes, the fund didn't sell anything. It borrowed against its own portfolio to pay her. Her fund now owes money it didn't owe before. She just doesn't know it yet because that debt sits at the fund level, not on her statement. And here's the part that should actually concern you. NAV lenders don't sit alongside investors. They sit above them. If the portfolio loses value, the lender gets paid back first in full before a single dollar reaches your pension fund. That's leverage on leverage. This isn't small anymore. There's now roughly $150 billion in outstanding NAV loans, and that number keeps climbing every year. NAV lending itself isn't inherently a scam. Used the right way, it's a legitimate tool. But the version used to manufacture a distribution right before a fundraise isn't financing. It's stagecraft. It's borrowing against tomorrow to make today look finished. And the people holding the bag if those valuations are wrong aren't the banks. It's the pension funds, the retirees, the savers sitting at the very bottom of a capital structure they never agreed to. Watch the full breakdown linked here to see exactly how this $150 billion mechanism actually works.